So you no longer suffer. I think the last seppuku like that was sometime in 1960s. They had a lot of those after the Second World War. A lot of generals committed seppuku. By the way, it's never harakiri. It's called seppuku. I'm also a big fan of anything Japanese. All right. Now, what's a reasonable number for that equity ratio? That depends on the industry. Certain industries require a lot of upfront investment. If you're gonna do airlines, I mean, you have an asset that you have to pay a lot of money now, but it produces returns over a long period of time. Even the most conservative airline company, Southwest Airlines, they have a debt equity ratio of about 2. If you look at American Airlines, then Delta, it's about 4. That's one of the reasons why they get into trouble so much, and Southwest doesn't, because in the American political system, if you're an airline, heads they win, tails public loses. We know what happened during COVID times. Sometimes they don't manage their risk properly. You know, when the oil prices jumped from about $30 to over $130 during the second Iraq War, the only airline that was actually financially solvent was Southwest. Why? Because they hedged their oil price risk. The other guys haven't. So what happened? Somebody had to bail them out. There is another ratio we use for long-term solvency. This one, there is no independent information, but sometimes people like total debt ratio. I think my battery is running out. TDR, it's total liabilities divided by total assets. If you work out the algebra, you can actually write this as the equity ratio divided by 1 plus the equity ratio. So those two do not contain independent information. If you know that equity ratio, you can calculate total debt ratio. Similarly, if you know the total debt ratio, you can calculate uh, debt equity ratio. If I'm not mistaken, let me see, I have about 10 minutes or so left. We are going to be more interested in coverage ratios. Things like debt equity or total debt ratio tell a story of longer term financial fragility. And if something bad happens to the firm, do they have enough assets or equity to cover that debt? But coverage ratios tell a different story. They say, you know, ability to service debt and cost of debt service is interest payments. There are two of them we use. One of them is called uh, times interest earned, or the TIE ratio. That's EBIT. EBIT is short for earnings before income and tax, interest and taxes, divided by the interest expense. So this basically says before you have to pay interest and the taxes, how much money are you making to cover the interest expense? Of course, if you think about EBIT, you can think about EBIT as sales minus costs minus depreciation. One objection to this is depreciation A varies across firms and across industries, and it's a non-cash expense. So we probably shouldn't use that as a kind of a measure of ability to make interest payments. So the second ratio we're going to use is called cash coverage ratio. Come on. And that's equal to EBIT plus depreciation over interest. And this number is sometimes called EBITDA. It's going to come up again when we do price multiples. It's earnings before interest, taxes, depreciation, and amortizations. For example, let's look at Walmart. In fact, we can look at Kroger as well, since we have their income statements. So, pi essentially operating income divided by, where is the interest expense? They also have two of them. As I said, there's no standard. So that's 10, around 10 every year. And, oops. And cash coverage ratio. You can basically say, oh, depreciation is not even here. But let me not calculate it. But you may guess that it's going to be higher. Uh, Times interest ratio of 10 is a pretty high number. I mean, typically you want it to be at least two. You know, they got to be able to cover at least 2 years worth of interest with earnings. The reason I don't have depreciation for Walmart, you get the depreciation number from statement of cash flows. Sometimes they put it here, but in many cases, it's in statement of cash flows, which we could have gotten it. For example, let me see, right there. And I also use some other stuff when I do this for real. for analysis purposes. In addition to depreciation and amortization, uh, there are some non-cash costs as well. For example, share-based employee compensation, especially if the firms are giving a lot of stock options. Example, Elon Musk, most of his wealth are from the stock options. And I think he gets a salary of only $1, cash salary. But he made so much money from those. Back in 2012 and 13, he had stock options that were granted to him at, I think, $12 a share. By 2022, this was before the split, he had to exercise them, otherwise they were expiring. And the tax bill on that alone was $2 billion. He sold them over $1,000. So that's where most of his wealth is coming. Let's stop here for today. On Wednesday, we're going to talk about asset efficiency ratios, things like inventory turnovers, total asset turnover, receivables turnover. Basically, how efficient you are to generate sales by using least amount of assets. If there is time, we'll kind of get started on the profitability. Otherwise, we'll finish it up next Wednesday. I'll see you guys Wednesday.